Hello, I'm Brandon Christy, President of Christy Capital Management. I'm glad to bring to you today a conversation on the Roth Tsp. The Roth Tsp is a viable option for the federal employees to consider. First, let's look at the basics of the Roth Tsp and the Roth Ira. For tax purposes, consider these accounts as wrappers for your money. Money goes into this wrapper after tax, thus you've already paid tax on the seed of your investment. Inside of the Roth Tsp, you can have the G, F, C, S, and I, or the L funds. Or if you have a Roth IRA, you can have mutual funds, annuities, gold, real estate, and many other options. The money in these accounts grows tax-free. The distributions from these accounts can be tax-free. The overarching principle: pay tax on the seed and not on the harvest. First, we should examine the key benefits of a Roth IRA, then the Roth Tsp. Most importantly, there are no taxes or penalties on the gains when minimum requirements are met. Generally, you must hold the Roth IRA for 5 years and be over 59 and a half. You have full access to your basis in a Roth IRA immediately. To illustrate, if you place $5,000 into a Roth IRA, the next day you can withdraw your $5,000 with no tax or penalty consequences. There are no required minimum distributions on Roth IRAs. There are RMDs on TSP funds. We'll look more at that in just a moment. Note, if your adjusted gross income is over the limit, you cannot contribute money directly to a Roth IRA. Contribution limits exist with catch-up opportunities if you are 50 or older. Separately, you may convert an existing IRA to a Roth IRA at any time. You'll pay taxes on such conversion, so be careful when doing this. You cannot convert existing TSP money to Roth Tsp. As a side note, CSRS have the opportunity to create a large Roth IRA based on certain criteria used within the Voluntary Contribution Program. CSRS are the only ones that can participate in this program. You can contribute up to 10% of your lifetime earnings into the Voluntary Contribution Program and then roll the money into a Roth IRA. Please review our video on the subject for more detail. Now for the details on the Roth Tsp. You have the same limits that you have had with your traditional TSP contributions. These limits should continue to increase based on inflationary effects. These limits are ERISA rule limits and not your individual account limits, giving much more flexibility and opportunity to contribute. By the way, you may be able to contribute to a Roth IRA and the Roth Tsp in the same year. Contributions to these programs are completely separate and distinct from each other. A few things of what the Tsp is not. There are no income restrictions. You cannot convert existing traditional TSP to a Roth Tsp, although the Small Business Job Act of 2010 permits such an option if the plan sponsor elects to allow it. The Tsp at this point does not permit it. Next, it is not all or nothing. You can contribute any portion of your funds to the traditional TSP or the Roth Tsp. And lastly, for FERS, the employer match will not be contributed to the Roth Tsp. Let's look at an example of what this means to your net paycheck. Assume you have an $80,000 annual wage, you have your gross pay, a TSP contribution of $600 per pay period, after estimated taxes, and again we're estimating just to give you a ballpark of how this would affect you personally. Your net pay would be, say, $1,688 per pay period. If you would change that $600 of traditional TSP contribution to a Roth contribution, you would incur more taxes on your current pay stub and take a net reduction in your pay at approximately $125 per pay period. If you are not comfortable with the reduction in your pay, consider reducing your contribution amount to the Roth Tsp. Always make sure you are continuing to get your 5% match as a FERS employee. Next, let's look at one reason why someone would consider a Roth TSP. We have here the tax bracket system in America. We find that when a couple makes more than a certain amount of taxable income, the marginal rate moves from 15% to 25%. Let's assume that your taxable income was $10,000 above the top of the 15% bracket. You should consider contributing about $10,000 to the traditional TSP. Once your total taxable income dropped below the 25% bracket, you may want to contribute the remaining dollars to the Roth TSP component, allowing your current income to stay at the top of the 15% bracket. Spending the dollars on taxes on the Roth TSP at the 15 cent on the dollar rate, but saving the tax dollars on the traditional TSP at the 25 cent on the dollar rate. Do be careful to think through how such decisions and strategies will affect your tax return. Be mindful of alternative minimum tax, medical deductions, and other phase-outs. For additional information, you can contact Christy Capital Management at 866-331-7749.